Hello everybody and welcome to Project Trade. This is the Technical Indicators Show, and in this one we are taking a look at the Ichimoku Kinko Hyo indicator, which for the sake of brevity we will henceforth call by abbreviated names such as the Ichi indicator, maybe the occasional Hyo. Alright, introduced in 1968 by Japanese journalist Goichi Hosoda, the Ichi indicator had been a long time in the making at the point of its release. It's a diverse indicator designed to give you an understanding of the latest price action on your chart in a single glance. No fuss is exactly equal to no muss. They're called businessmen and businesswomen because they are busy people. They don't have time to mess around with a million different statistics and interpretations. They want it all in one quick go. A full and complete understanding of price action that clearly needs no other reference point. It's got both trend and momentum in there, as well as having an eye for potential support and resistance levels as well. A jack of all trades and a master of none, as the saying goes. But how is it able to attempt such a broad and wide-ranging feat all inside of one indicator alone? Well, the secret sauce is in the fact that it's got 5 elements to it. So it is actually 5 separate formulas built onto the chart as individual parts of the greater picture. The Ichi indicator looks like this on your price chart. What a mess, am I right? Really clusters up the chart, especially if price is having a bit of whipsaw time. Looking at this makes me feel as though I understand price less than if I was looking at nothing but the price on a line chart. Let's go through each of the individual parts and break them down. We'll start with what is known as the conversion line. That is the TENKAN-SEN. Pretty simple for this one. You look back at the last 9 periods of price, you take the highest high and the lowest low in price from that look back frame and divide the total by 2. The result is then plotted as a data point on your chart and linked to the previous period's data point with a straight line. Here is a bunch of those data points connected together on an example price chart. Looks very similar to a moving average, right? And that's effectively how it's used. It can do anything that a moving average can do, so it is great to think of it that way. On to the second part of the Ichi indicator, the KIJUN-SEN, also known as the baseline. This is the same formula as the TENKAN-SEN, where the highest high and lowest low of price are added together and divided by 2. But in the KIJUN-SEN, the look back is over 26 periods compared to the Tenkan's 9. Here's an example of the Kijun. This is your slower moving average, and its longer look back does mean that the line is going to drift further from price than the Tenkan-Sen does, particularly if price gets a strong trend on the go. Let's go to part 3, that is Senkou span A. The formula for this line adds together the values of the Tenkan-Sen and the Kijun-Sen calculations, then divides that figure by 2. Here's the kicker though, it plots the result 26 periods forward from the current period. Before we show you what Senkou span A looks like, we also need to understand Senkou span B. This is the 4th part of the indicator, and it uses the same formula as the Kijun and Tenkan lines, adding together the highest high and lowest low of price, then dividing that figure by 2. The look back for Senkou span B, however, is 52 periods, twice as far back as the slower Kijun line. Here's the kicker though, it plots the result 26 periods forward from the current period. Because of how they're plotted forward, the Senkou spans are sometimes known as leading span A and leading span B respectively. When we plot both Senkou span A and Senkou span B onto the price chart, the space between them is colored in to make the KUMO, meaning the cloud, because it looks like a cloud. It is a rational nickname, and we are using green and orange as our colors for whether the cloud is going up or coming down. If you wanted to just see the upward KUMO, that will hopefully be an option on your charting platform. When it's going up, it means that the Senkou span A line is above of the Senkou span B line. And also, if you want a visual on just the downways KUMO, here's how that could look. In this instance, Senkou span A is beneath Senkou span B. Finally, part 5 of the Ichi indicator is the CHIKOU span line, also known as the lagging span, the delayed span, span the belated. Pretty basic with this one, seen as the wild card of the indicator for some reason. That's the word people use, seems to be a thing. It takes the current price and plots it 26 periods back from the current period. That gives you a visual such as in this example. Nothing special to it, just the current price 26 periods back. Some traders using the Ichi won't even have this line visible as they already have the information in front of them, and the indicator in full looks pretty hectic on the screen. So there we have our complete Ichi indicator, the KIJUN-SEN line, the TENKAN-SEN line, Senkou span A, Senkou span B, and the CHIKOU span. All of the formulas and examples that you've seen are just using the standard default inputs for each of those formulas, but your platform should allow you to change most of the settings, hopefully all of the settings, but maybe not. Now that we understand each of the individual components, we can take another look at a complete the Ichi indicator on this price chart. It does still look clunky, but at least we know what all of the clunk means this time. Let's take a look at the entry signals that we get from the Ichi indicator, and then maybe it'll appear even less clunky. First, we've got the TENKAN-SEN crossing the KIJUN-SEN. That's our faster 9-period conversion line crossing over the slower 26-period baseline. Here's a couple examples of that. Where our white TENKAN-SEN line crosses above the aqua Kijun, we would enter buy trades at these points. It is almost always a lagging bullish indication when a faster moving average is on top of a slower moving average. And invert that for when the Tenkan crosses underneath the Kijun. That indicates that sellers have taken control, and so you should join them with a sell trade. This is of course just a moving average crossover. It is no different. The next signal we can consider is entering a trade when price breaks either above or below the KUMO cloud. On our chart here, the thought process behind this basic signal of the cloud is that when price is inside the cloud, it can indicate uncertainty over price, and it is very common to see price inside the cloud when it gets deep into a range. This is notable in the bottom left of our chart. We see price without any clear direction. Then when price breaks above the cloud, it is a signal for a potential buy trade, as the indicator believes that buying momentum is strong enough to push out the price uncertainty. Either side of the cloud can be seen as dynamic support and resistance levels, so this is similar to trading a breakthrough strategy with support and resistance. And in this pre-selected instance, price really does go on a run. On this cherry-picked occasion, we'd be taking some very nice gains. The breakthrough signal is just the opposite when price breaches under the cloud. Those circumstances lead us by horse into Selltown City. Here's a pretty clear example, and would you look at that, we're going to be in the money again here, aren't we? We'll take that profit. Where does he find these charts? They are not the ones that I'm used to. Those signals, they don't have to be from price crossing entirely through the KUMO either. They can be used effectively for when price re-enters the KUMO but exits back out onto the same side of the KUMO as it was before. Such as in this example, price shunts into the cloud, and as it comes back out, we wait for the full body of the candle to be above the cloud again, and when it is, we enter that buy trade. Profits ahoy! Again, as the KUMO cloud can be seen as support and resistance levels, when price bounces back out of the cloud on our chart, it is essentially rejecting the support level, which is therefore suggesting price could go up. Just the opposite in this picture, we see price moves into the cloud, tagging into it just momentarily, but that is all we need to pounce. Price comes back out, and we enter in at the bottom of that first red candle with confirmation of the full body being outside of the cloud. We put on our sell trade hat and we wait. Eventually, I'm sure with enough skill, we'd be taking our profits where that small yellow ring is, right at the bottom of price before it heads back up towards the cloud. Profits, profits, profits for us. The system works. Real life situations may not be represented within the selected image. Another simple signal within the Ichi indicator comes from the CHIKOU span line, and it is based on when the CHIKOU line breaks above or below price. When the CHIKOU span crosses above price, that can be a signal for you to get into a buy trade, as it means the current price is higher than it was 26 periods ago, so buyers must have taken some control of the situation since then. We've highlighted with our blue arrows where the CHIKOU span crossed above price and where that correlates to in terms of our actual entry price. We taking profits on this one, oh yeah. Flip it over for a sell trade. That comes as a signal when the CHIKOU span finds its way below price. Here's a couple examples of those entries. Again, we've marked them with the arrows connecting the spot where the CHIKOU span crosses through with where the actual entry in would be. In both of those instances, there is plenty of chance for taking profits if you've got a good system for snapping them up. I'm sure you do. We got another signal. We got the KUMO cloud twist. It's great saying it in Japanese and then in English, by the way. KUMO cloud. It's basically just saying KUMO KUMO or cloud cloud. Either way, the KUMO cloud twist, it isn't a 1950s dance move. It is when the cloud switches from going upwards to going downwards, or vice versa. Senkou span A races across Senkou span B. In this example, we see a long period of an orange downwards KUMO cloud in the middle of our price chart. Then Senkou span A crosses above Senkou span B, and we are entering a sell trade. Remember though, the KUMO cloud is plotted 26 periods forward, so we're not or entering on where we visualize the crossover candle to be, we're entering 26 periods back from the crossover, which is all the way back there. Even better, that's more profits for us as we ride it all the way up, no hesitations. Here's the reverse, but on this example chart, we are seeing the close of our entry candle. 26 periods forward from that candle, our Kumo cloud is twisting over from green to orange, meaning sell, 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 and so we do. Outcome unknown, but who are we kidding? We know that it's profits. Any or all of those signals can work as a filter as well, instead of working as an actual trade entry signal. You might say, for example, that you'll only take buy trades from your other entry indicators if price is above the cloud, or only if the Tenkan line is above the Kijun line. You'll only take sell trades from your other entry indicators if the Chikou span is below price or if the cloud is twisted downward. There are a lot of options. Trend filters are a pretty popular tool, but between all of those entry signals, we have used each of the individual parts of the Ichi indicator to give us a variety of trade entry options. But despite the charts we've shown you as individual signals, they're really not going to be very consistent signals. That's okay though, they don't have to be used alone. You can and absolutely should mix and match them for better performance than using them as solo parts. Example 1 signal mix shows where we combine the fact that price is above the upwards Kumo cloud with the notion of the moving average crossover. It gives us an entry signal here when our Tenkan conversion line crosses above the Kijun baseline after a brief spell of being beneath it. We can see that it does manage to hit the trend, and if you're not getting profits on a move like that, maybe you could be interested in signal mix 2. We use the same moving average crossover, but in this one we've taken out the Kumo cloud and replaced it with the Chikou span. And we're only taking those crossovers when the Chikou is on the same side of price as the direction of the crossover. There's 2 crossovers for sell trades on the chart marked out with the yellow rings, and if we look at the Chikou span at 26 periods prior to those entry points in price, we can see that the indicator line is beneath the price, which is going to confirm that we are all good to take the sell trades. Here's another signal mix example 3. In this one, you're taking your entry signals from the Chikou span, so when the yellow line crosses above price, that will be a buy trade, but only if the Kumo cloud is green colored, indicating upward momentum. And if we measure it out with the aqua colored arrows from the ring, we can see that when the Chikou span crosses price, we are all good to get into that buy trade as the cloud is green. So as we said, many combinations, multiple mixes. Are any of them actually any good though? Well, maybe with the hopes of trying to improve consistency, you should only take signals from our all signal mix. This is our full Ichi indicator, hopefully looking a bit less clunky now with a buy entry signal here. The Tenkan-Sen line crosses the KIJUN-SEN line. We've got the price comfortably above the Kumo cloud, the Chikou span above price 26 periods back, and the Kumo cloud 26 period forward in the green upward mode. All the signals in unison together, leading you into a fantastic buy trade where you are near certain to claim profits. With such high level of confidence, the trades could hardly go wrong. And you've only got 2 wishes left. Moving on, with all the different ways the Ichi indicator has to get you into trades, it's got to be able to help you get out of trades too, right? Help you defend your money. It sure can. To start with, we've got the easy basic go-to move of turning our entry signals inside out and making them our exit signals instead. Here's a reminder of those. So if the faster Tenkan-Sen line crosses below the Kijun-Sen line, that would be an exit signal for a buy trade. And if it crosses above, that would be an exit signal for a sell trade. Price moving into the Kumo cloud away from your trade direction can be used for you to jump out of a trade, as that's suggesting to you uncertainty in the upcoming price movement. The Chikou span, if its line crosses below the price 26 periods back, you could exit a buy trade. This one actually ends up working in a similar fashion to a trading stop loss, because if you were in a decent upward moving trend with your buy trade, the Chikou span coming back down through the previous price will mean you wouldn't really get out right at the top, but it would be a little bit back from there after price retraced. All this is contingent, of course, on your trend having traded for longer than 26 periods. This is just switched around vice versa for if the Chikou span goes above the price and you're in a sell trade, that can be your signal to get out of town and take what profits you have. And finally, if that Kumo cloud twists against you. So for a buy trade, the forward plotted cloud flips downward, you shut off your trade. And if it's for a sell trade and the cloud flips upward, well, you're gone from that one as well. Much like as entry signals, they are not all going to be great. The signals still lag, which the market can often punish, KUMO cloud or no, but they can act as exit signals nevertheless. You can also use a few of the itchy parts as a stop loss or a trailing stop loss. We'll start with the slower average, the KIJUN-SEN line. Not always a bad idea having a stop loss at the initial KIJUN-SEN level. On our chart, we've got the KIJUN-SEN in blue and our TENKAN-SEN in white. If we say we enter after the TENKAN-SEN closes across the KIJUN-SEN, then our trade entry would be here. That's at the beginning of the green candle into a sell trade as we wait for the close of the cross before we jump in. Then our stop loss would be on the top of that initial KIJUN-SEN line. It gives us a bit of room to maneuver, and you've got options at that point. For example, you could use a 1-to-1 risk reward ratio where your take profit level is the green dotted line. You'd be all good on that one, or double it up with a 2-to-1 risk reward ratio. You'd have just about managed that one as well. Pretty nice trending move on the whole. Or you could instead trail the stop loss along the KIJUN-SEN line. Every time it reaches a new low for your sell trade here, you shift it lower. It's a useful method if you do think that it's going to be a trend that keeps on giving without any retracements that are big enough to get you. Those stop loss options, they aren't really available with the faster TENKAN-SEN line. If you set any sort of stop loss on the TENKAN-SEN line, it is almost certainly going to get kicked over pretty quickly because of how closely the TENKAN-SEN line stays to price. It would certainly make for an incredibly inconsistent tool in that role. Well, actually, it wouldn't be inconsistent, it would be consistently bad. This is the same price chart from just before, and where the KIJUN-SEN line had performed well, if we were instead using the TENKAN-SEN line as our stop loss with our entry point here, this would not go nearly so well for us. Right here is where we get the boot from the trade. Then putting our entry level on with the white dotted line, it really highlights that in fact it would have actually been a loss. So for the TENKAN-SEN line, it is not really feasible in any capacity as a stop loss, but it is an option with the KUMO cloud. As we said earlier, those upper and lower edges of the KUMO cloud are acting as sort of dynamic support and resistance levels. They too can be utilized as a stop loss. So on the chart in front of us, we'll say that we're entering when the full candle opens and closes above the KUMO cloud, which is way down in the bottom left where that yellow ring is. At that point, you can set your stop loss at the outer edge of the KUMO cloud. Then much like with the KIJUN-SEN examples, you could either have a 1-to-1 or 2-to-1 risk reward ratio, whatever you want, and you could also trail the stop loss with it as well, which in this instance wouldn't get hit for a long time, somewhere off the chart in fact. As with the faster TENKAN-SEN average, using the near side of the cloud can be a little risky at times. The beginning of the trade could easily get snapped out by a quick retracement. You might get trends here or there that are able to use it nicely as a trailing stop loss, but in my opinion, I think you are going to find you get knocked out of it too quickly, and therefore it is a bit on the inconsistent side. That means if you are using the KUMO cloud, my personal preference would be the outer edge. Just so we round off trying every part of the itchy indicator as a trailing stop loss, it doesn't work for the CHIKOU span because it's your current price. You'd be either always or never in a trade, but there are weird ways of using it if you're into that. For example, saying 10 periods into the trade, I will start the trailing stop loss from what the CHIKOU span was when I entered the trade. Technically, you can find ways like that to use it, but being exactly equal to 100 about it, I think there will be better ways to manage your money. And to be honest, whether any of these methods are likely to be affected over time at money management, unsure, but you never know. They are there to be tried. With the broadest possible outlook, you could at the very least say that if price is in the cloud, it is ranging and uncertain, and therefore you should possibly avoid trading. Money managed in the markets, it's fair to say that as a 1960s Japanese indicator, the Hyo has historically been predominantly used on forex charts, and specifically charts where one currency in the pair is the yen. That means it is probable that even still today, more people will be using the indicator on Japanese yen charts than others. That means that if you do want to try and game a self-fulfilling prophecy on the charts, which honestly, in my opinion, it is a very questionable judgment if you do want to, but if you do want to do that, I would say probably the US dollar Japanese yen pair on the daily time frame would be the most likely to have traders taking trades based off the itchy indicator if you wanted to follow them in. Good luck with that, won't work, but you might feel better at the fact that there are likely more people that are in it with you. Either way, with knowledge reaching as far as it does today, traders across continents use the Ichimoku indicator on all sorts of forex charts, as well as other asset classes too, metals, energies, stocks, all the usuals, all the regulars. Remember though, just because it's used in all markets doesn't mean that it will work in any of them. And don't forget those inbuilt filters to avoid the range or the trend if you're aiming for reversal trades. But assuming you are trading with the trend. If in doubt, don't trade when price is in the cloud, and you should avoid the worst of the range. That KUMO is your shelter from the storm. For similar indicators to the Ichimoku Kinko Hyo, we can look at the individual parts, starting with the easiest one, the CHIKOU span, current price. If you want to substitute for it, I know what to say, it's on the chart all the time. Maybe try Renko charts. For the TENKAN-SEN and KIJUN-SEN lines, we've mentioned it a couple times, they are no different from moving averages. You want to use the methodology of these lines in substitution for the moving averages, no harm, no foul there. You will not notice the difference in the types of signals you'll be wanting from any given moving average. When it comes to the cloud, we've talked about how they act as support and resistance levels, of which there are a lot of different types. Standard support and resistance, dynamic, Fibonacci levels. You can end up with hundreds if not thousands of different support and resistance levels on one chart. So whichever type of support and resistance you are using, maybe just stick to that one type. Having said all this though, as an individual indicator, the Ichimoku is fairly unique. There aren't many indicators out there with a lot of different moving parts on your price chart doing it like how the Ichi does. They certainly created something interesting with this one, and in conclusion, it is a jack of all, master of none if you're after an indicator which has a few mediocre tools in its arsenal which could potentially be brought together with a bigger end game. Do consider the Ichimoku indicator. There are plenty of signals and some of them will absolutely work sometimes. And when it comes to the Ichimoku signals, it doesn't have to be every part of the indicator. You can take out one element or another that you like of it, and you can combine certain parts of the indicator with other indicators if the results of the strategy will be improved because of it. Just get rid of those parts that you're not using and stick with what you need. You'll be good to go. Don't forget as well that it doesn't have to be all entry and exit signals though. The whole purpose of the thing is to be able to get a gauge on price with one look, not to guarantee you winning trades every time one of those signals comes along. Often the Ichi indicator is just better for giving you a more basic overview on what price has done in the past and what it's doing in the present. That is all the basics of the Hyo indicator, but still, if you are jonesing for a bit more, then there is some extra information and links in the video description. Just to be sure as well, this is your final warning that every single chart we showed you in this video was specifically pre-selected for showing you how the indicator may or may not work. We have tested this indicator in live forward testing strategies, so no kidding ourselves with just a back test. We will link those forward testing strategies in the description. Thank you for watching. This is Project Trade. I am the Technical Warlock, and there will be more.